Okay, so horticulture, just briefly, and return on capital, and this is what it's all about really, is how you turn your investment into cash, and remembering that return on capital is cash returns, not value of the asset increase. So obviously very important that the value of the asset, if it increases over time, whether that be land and water and plant, if you're replacing it, if that increases over time, that certainly contributes to the business wealth. But this is talking about cash returns in the business. So horticulture as a rule, this is 1920s year. So we've got a couple of years of presentation data, and then we'll combine them together. And we've done this for horticulture, pome and vegetables. The return on capital in that 1920 year of the top 25% was quite significant, so you can see across the average, we have a return on capital target of 8. And we use that number mainly because if you can average 8% return on capital each year, then over 10 years, you double the wealth in your business. So that's that little dotted line there. And obviously the best performers in horticulture across the board. So this is a combination of pome and vegetables. We're sitting at that about 18% return on capital. So a significant return in that, 1920 year. And obviously the average in the bottom part of the industry dropping below that target KPI we have of 8%. So remembering that's just the 1 year data. In 1920, the equity, so the equity balance sheets were actually quite strong in horticulture. So we can see that the average of the industry just sits above our target line of 80%. So that's a good thing for the industry. It means that balance sheets are strong. It means that if they need to invest, they can, or if they can buffer against poor seasons, they can, which is a great thing. One really key component here is that we're starting to see the top 25% do have much stronger balance sheets. That's into the 90s now, whereas the average of the industry is just below 80. So the good businesses are very strong businesses as well. And operating efficiency, this is again the single year results. So this is the percentage of costs as a percentage of income. So what that says at 78%, the average of the industry spent 78 cents to make $1. Now this is the engine room. So the lower that efficiency is, the better the business is at making money. And obviously that little grey line, or that grey part of the bar there, is contributing to overheads such as drawings in the business, interest, tax, depreciation. So that 78% number is really critical. We believe in the horticultural industry that target should be less than 70. So you can see the average of the industry is above that target, which means they've got less money left over after operating costs to actually pay for those overheads. So if you've got a high overhead business, you need that operating efficiency to be as low as you possibly can so you can contribute to those overheads.
Yep.
So that was that year. And then the return on capital in 2021. So similar graphs, you can see the differences in years now. Bryn, I suppose, is what we're seeing. So a really tough year in 2021 for horticulture as a rule, and mainly driven by yields and pricing was a big thing, but also we started to see those increasing costs as well. So the return on capital certainly dropped, but again, a distinct difference between the average and the top 25%. Albeit the average of the industry was still maintaining just under 5% return on capital, and the top 25% were just sitting on 7%. So, I think the returns are still there, but you can see that it's getting tougher for producers. And again, the equity percentages, 1 year on, a few more data sets actually, Bryn, from 1 year to the other across horticulture. So again, just the strengthening of balance sheets again here. So just seeing the real importance of a higher number of contributors to the data set, and more growers in, the better the data becomes, the stronger it is. So a good position from an equity point of view, but like I said earlier, as your increase in assets increase, so if the value of your land increases, you have to make more money to actually make that return better. But the equity does mean that they're in a good position to handle a poor year, which horticulture has been through a number of in the last 5 years. Okay, and this is probably again depicting the year that it was. So their operating efficiency, it's at 80%, slightly higher than the year before. Yeah, so just, it's a very important factor, and it just means that the costs that were employed to drive income were going up. that year. So the income didn't respond or the costs were higher. So a combination of both. So, you know, a really important metric that we use a lot of, and we then use this data for each of our growers to dive in and say, okay, what is affecting this operating efficiency in your business? So that's where the conversation starts.
Yeah.
And horticulture, so we've got 2 years of data across the industry now, obviously. So we've got 2 years of Pome and 2 years of vegetables, being that last 19, 20, 21 year. And I think the key part of this industry results is just that we've got 2 years of quite good returns for the top 25% and then lower ones. But what we're starting to see is this operating efficiency come out as the key component of where I think businesses need to really keep concentrating on, whether you're in vegetables, Pome, and even other industries that aren't involved in this project at this stage. So, you know, the 2 year average close to 80%, you know, it's at 79%, 9% higher than we'd like you to be. Like there's 9% of income which is going to costs that aren't being rewarded back. So the return on capital at 5.5%, arguably still a good return, better than cash returns. Arguably, is your capital better to be in the share market? Probably not in recent times, but these are the things that growers can make decisions on. And obviously equity we mentioned was, you know, the businesses are in a strong position. So yeah, look, and a couple of graphs at the bottom to just depict the difference between 19, 20, and you can see that variation. And I think when we get to vegetables, we'll really hone in on what the 5 year data set looks like, because you start to really pull out some interesting information, Bryn, on equity, return on capital, and operating efficiency, which are key drivers.